Swayam Prabha. Digital India. Educated India.
Yoga Karmasu Kaushalam.
Dear students, my name is Dr. Dhaval Nakum from Gujarat University. Today I will talk about Fundamentals of Accountancy Part 1. In the BBA degree course, different types of subjects are taught and accounting is one of them. Before directly proceeding to understand the accounting subject, let us first see the relevance of the accounting subject for the BBA degree course. Relevance of accounting subject with BBA course. BBA course can be considered as fundamental or primary degree to pursue a master's degree in business administration and other commerce faculty related master's degree courses. It deals with the administrative and managerial aspects of both business and non-business organizations. This course is a branch of the commerce faculty. Commerce faculty itself is a horizontal branch of the education system dealing with variety of subjects like mathematics, statistics, finance, marketing, human resource management and many more. Accounting is also one of them. The following objectives may be considered for the inclusion of the accounting subject in BBA degree. The very first objective is accounting deals with the preparation and presentation of accounts. The preparation and presentation of accounts is a legal task and hence its knowledge is essential for any graduate of administration and management course. Further, accounting is a branch of social science. Social science evolves with changes in society and accounting incorporates these changes to meet the societal needs. The very second objective of inclusion of accounting in BBA course is accounting and specifically financial accounting deals with historical results which are used by management for formation of their future business strategies. These historical results include profit and loss statement which explains profitability of the business for a particular period of time and economic position of the specific day through the balance sheet. Financial accounting includes annual accounts of sole proprietors, partnership firms, non-trading concern, companies, etc. Another branch of accounting is cost accounting which deals with cost determination of product and services of different industries. Cost accounting includes single output costing, operating costing, process costing, contract costing, etc. The third important branch of accounting is management accounting, where managerial accounts and their analysis is done. This branch of accounting helps management to take strategy oriented decisions. It includes ratio analysis, cash flow statement, marginal costing, etc. The computation of tax liability is based on accurate and precise financial accounting information. Accounting helps to reduce any legal disputes between business organization and tax authorities. Thus, knowledge of accounting also aids in tax liability determination. Therefore, being a student of any administration or management related courses, accounting knowledge makes you more comfortable and systematic in handling accounting and tax related issues. Objectives of these modules are to understand the meaning of accounting, definitions of accounting, to understand the characteristics of accounting, objectives of accounting and advantages and limitations of accounting. Let us see the historical and present status of accounting. The historical background of accounting. In society, individuals try to meet their needs in different ways. each person has a distinct and unique existence in the universe. A human being is an intellectual animal who interacts with society to fulfill social, religious and economic needs. To fulfill these needs, individuals must rely on the support of others in the community. Since no one can be an expert in all required fields, individuals must seek help from other people or groups. Here, skills, products and services are exchanged to meet these needs. Every individual exchanges their skills with others in society. Each individual provides services of their special skills or products or services to others and in return receives skills, products or services from other skilled individuals. In old days, money did not exist as a medium of exchange. At that time, the barter system was used. Under this system, skills or products or services were exchanged against other skills or products or services. The barter system prevailed in the economy due to the absence of money as a medium of exchange. For example, a grain merchant sells different types of grain and a cloth merchant sells different types of cloth in the town. Under the barter system, grain could be exchanged for cloth according to an agreed quantum of both the products. It is called the barter system because a universally accepted exchange system did not exist. This barter transaction involves the exchange of products. There could also be exchange of products for skills or services. However, the barter system had practical limitations regarding value measurement, and this was issue of determination of equal value establishment of exchange of two products. These limitation of barter system compelled the development of a universally accepted and balanced method. Very pertinent, fast and safe exchange system has developed over time across the globe. In present time, money is used as a medium of exchange. Money is used in physical forms such as coins and currency notes for transactions, and also in non-physical forms like plastic currency like credit card, debit cards or internet banking services. In these later forms, no physical money is required. Through plastic money or internet banking, the agreed amount is deducted from the purchaser's bank account and added to the seller's bank account. For such system where money is used in any form as a medium of exchange is known as a monetary or economic transaction. Under this system, by selling a product, money is obtained, and with this acquired money again products is purchased. Thus, it can be said that products purchases money and money purchases products. Transactions, whether made through the barter system or the monetary system, need to be recorded and accounts to be prepared. It is mentioned in the history of accounting that accounts were maintained in ancient times as well. The origin of accounting is claimed by different authors in different manner. In India, Indian historians have described the economics of Chanakya and explained the existence and significance of accounting. Western historians have given credit to the mathematician Luca Pacioli of Italy for the same. There are several opinions about the origin of accounting, but for its use and significance, common practices prevail across the world. Due to the Industrial Revolution and the expansion of business, trade activities, the use and significance of accounting has increased remarkably day by day. Nowadays, the manual accounting system is replaced by the computerized accounting system, and different types of common and customized softwares are available in the open market. The shift from manual to computerized accounting has not wiped out the needs and importance of accounting. Before gaining information about accounting, let us acquire a basic familiarity with accounting concepts. When the word account comes to mind, it often brings attention to profit and loss. Profit and loss are not transactions but events, means the results of the transactions. Transactions are in the form of receipt or income and payment or expense. the difference between receipt and payment or income and expense represents the result, which is profit or loss. When receipt is greater than payment or income is greater than expense, the difference is called profit. When receipt is less than payment or income is less than expense, the difference is called a loss. From accounting viewpoint, the meaning of receipt, payment, income and expense is different. All these terms are used for specific purposes and specific transactions. In accounting, the difference between income and expense is known as profit or loss, as the case may be. However, the difference between receipt and payment is known as the balance of cash. For example, a trader has purchased goods for rupees 50,000 and paid transportation expense of rupees 20,000. The entire purchased goods are sold for rupees 1,50,000. Here, the income is 1,50,000, against which expenses are 70,000, 50,000 of the purchased goods and 20,000 of the transportation cost. So, in total 70,000. Thus, the difference of 80,000, that is income of 150 and expenses of 70,000, if we take the difference, the 80,000 is called profit or gain. If a trader has purchased a goods for rupees 50,000 and paid transportation expense of rupees 20,000 and the entire purchased goods are sold for rupees 60,000, here the income is rupees 60,000 only, against which expenses are 70,000 in total. Thus, the negative difference of 10,000, that is 60,000 of income and 70,000 of expense, is called a loss or deficit. For profit or loss determination, profit and loss account or income and expenditure account is prepared. In accounting terminology, receipts and payments deals with cash inward and cash outward respectively. Cash inward and outward includes bank transactions also. For example, a trader has purchased goods for rupees 50,000 on credit and paid transportation expenses of rupees 20,000. The entire purchased goods are sold for rupees 1,50,000 in cash. Here the cash inward, that is cash receipt, is rupees 1,50,000, against which the cash outward, that is cash payment, is only rupees 20,000, the transportation expense paid in cash, while the purchase is on credit and cash for that is to be paid in future. Thus, the difference of rupees 1,30,000, that is rupees 1,50,000 receipt and only rupees 20,000 payment towards the transportation expense, is called the cash balance on that respective day. For cash balance determination, a receipt and payment account is prepared. The preparation of profit and loss account is based on the mercantile system of accounting, while the receipt and payment account is prepared based on the cash system. Both systems are explained hereafter. A method or system used to maintain accounts is called accounting. Accounts are also known as bookkeeping. The term accounting is used synonymously with bookkeeping. In this module, the term accounting is used in place of bookkeeping. Just like subjects such as physics, chemistry, mathematics, accounting is also has its own existence and significance in society. Accounting has its own special utility. Accounting has its own rules and principles. It is treated as an art and a science both. Professional bodies are working at national and international levels for the smooth functioning of the accounting system. Now we will understand the meaning of accounting from the viewpoint of accounting bodies. Meaning and definitions of accounting. Accounting is a profession, and for its management and regulation, professional bodies are working at national and international levels. These bodies function to maintain uniformity in the accounting system. On the basis of definitions, the concept of accounting can be understood. Let us see the definition given by the AICPA, the American Institute of Certified Public Accountants. Accounting is an art of recording, classifying and summarizing in a significant manner and in terms of money transaction and events which are in part at least of a financial character and interpreting the results thereof. As stated earlier, accounting is a branch of social science and society keeps on developing new areas. Being a branch of social science, accounting also incorporates these changes. Thus, the meaning and definition of accounting are also modifying over time. Keeping in mind the development of accounting, another definition is given by the ASC, American Standards Council. It is a service activity. Its function is to provide quantitative information, primarily financial in nature, about economic entities that is intended to be useful in making economic decisions. From the above mentioned definitions, the characteristics of accounting can be ascertained. Let us look at the characteristics of accounting. The very first characteristic of accounting is financial characteristic. Refer to the definition given by the AICPA, American Institute of Certified Public Accountants, where it is stated that accounting is an art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. Transactions or events recorded in accounting must be measurable in monetary value. For example, if 50,000 meter of cotton are purchased by X from Y, the value of these purchase has to be determined in a monetary terms. This cotton is purchased for rupees 2,20,000, meaning that 50,000 meters of cotton equals to 2,20,000 rupees. In exchange for the cotton, rupees 2,20,000 is payable by the X. Rupee is money in the Indian economy. It is the Indian currency, and in India transactions are done in domestic currency only, which is rupee. Each country has its own currency and they undertake transaction in its own currency. When transaction is made through money, it is known as an economic transactions. Any transaction involving money is an economic transaction, and therefore, every economic transaction has a financial characteristic. The second characteristic of accounting is money as a medium of exchange. Every business dealing operates on a reciprocal or two-way system, where a product or service is provided on one side and something is given in return on the other side. In brief, for the receipt of a product or service, a specific exchange is to be done. This exchange is done in the form of money only. Therefore, money is a fundamental component and is treated as a medium of exchange. Transactions or event recorded in accounting come into existence through the use of money. Money as an exchange for a product or service will be received by Y, who is the seller, for the 50,000 meters of cotton sold, and he will get rupees 2,20,000 from the X in the form of money, who is the purchaser or buyer. Let us understand the transaction between the seller and the purchaser. Here Y is the seller of cotton and he would send cotton to the X, who is the purchaser, and in return X, who is a purchaser of cotton, would send money to Y, who is the seller. Thus, instead of exchanging a product or service for another product or service, now the product is exchanged for the money. It is important to note that money is a medium of exchange with legal existence and acceptance. Additionally, it is acceptable to both parties according to the national regulations. The third characteristic of accounting is classification and analysis of transactions. According to the definition of the AICPA, three important functions are performed by accounting for any transaction. First is recording, second is classifying, and third is analyzing. In accounting, these functions are not confined to a single transaction. Numerous transactions are recorded and one transaction may not be similar to the another. Therefore, a wide range of transaction is recorded in accounting. Additionally, accounting transactions can be in cash and non-cash forms. These transactions are related to any income, expense, asset or liability based activity. They are classified and analyzed based on their nature, derived from applicable debit and credit rules of accounting, which are going to be discussed hereafter. Due to the quality of classification and analysis, transactions within a prescribed time frame can be seen together in one place. For example, let us understand the status of liabilities. What was the opening balance of liabilities? How many liabilities increased during the required period? Then how many liabilities were paid during the required period, and what is the closing balance of the liabilities? Answer to all these questions are obtained from one place because of the classification and analysis features of accounting. Thus, it is an important feature of accounting. The next feature of accounting is interpretation of transactions. Accounting has different sub branches, with financial accounting being the main and primary type. Financial accounting is also known as historical accounting, which means accounts are prepared based on historical data. In financial accounting, accounts are not only prepared but also interpreted based on disclosed details and figures for the managerial decisions or future strategy development. Here the figures, which is also called as a quantitative information. For example, a businessman X has a total income of rupees 20 lakh and total expenses of rupees 12 lakh. The difference of rupees 8 lakh is the excess of income over expenses, indicating that the business has benefited from these transactions. The difference between income and expense is in the form of profit. As a percentage, it comes to 40%, that is rupees 8 lakh of profit divided by the 20 lakh of income and multiplied by the 100, we get the 40%. It indicates that the profitability of Axis business is 40%. If a competitor has a profitability of 30%, it means Axis business is in a better position than the competitor. If the competitor has a 50% profitability, X needs to improve his business activities and develop necessary strategies to compete with the competitor. In this manner, interpretation of expenses, assets and liabilities can also be done with the help of appropriate tools of financial accounting. The next characteristic of accounting is quantitative monetary information. Only quantitative data or information has the quality of comparison. Qualitative aspects like emotion, trust, understanding, loyalty, commitment and dedication cannot be measured but can be felt relatively. In accounting, all transactions with monetary value are recorded. These business transactions are measured in terms of money and are disclosed in the books with their applicable value. However, in spite of having monetary value, transactions may not be recorded in the books. For example, an order to supply goods worth rupees 25,000 does not create relationship between the supplier and the receiver until the goods are supplied or money is paid. Thus, only quantification is not important, but other conditions must also be fulfilled for a transaction to be considered an economic transaction. The next characteristic of accounting is economic, that is investment decisions. Accounts prepared by the corporate sector are not confined to internal purposes, but are available in the public domain also. These published accounts are used by different stakeholders such as creditors, fund suppliers, government, regulatory bodies, professional bodies, existing shareholders and potential shareholders for various reasons. These accounts disclose the earning capacity of the company, economic condition of the company, future strategy of the company, etc. The accounts cover quantitative and qualitative data, making it easier for respective stakeholders to make informed decisions. The company itself also makes decisions for its own development based on these accounts. All these decisions are based on money, thus known as economic decisions. Thus, accounting assists in making economic decisions. The very last characteristic of accounting is historical information. There are three situations: past, present and future. Each has its relevance and significance. For example, planning deals with the future and existing selling deals with the present. However, financial accounting deals with the past only. In financial accounting, all past transactions and events are recorded as historical information. Accounts prepared based on history represents historical information and results. Thus, financial accounting has relation with the historical information only. Any information created in financial accounting is converted into results through a specific process. This process is principle based and scientific, consisting of different stages. Each stage of the accounting process provides specific outcomes. The stages of the accounting process or accounting cycle are given here in the form of figure. It is desirable to note that all stages disclosed here are to be followed in order only. No subjectivity is allowed in the context of these stages. This process deals with recording in books, that is in journal and subsidiary books. The second stage involves posting of these entries. The third stage is the preparation of the trial balance. The fourth stage involves the preparation of annual accounts and interpretation of results. After interpreting the conclusion, a report is prepared. Here the term report refers to accounting, that is annual account, and this is going to be discussed in the subsequent chapter. Let us see the presentation of the accounting process in the form of a figure. We can divide this process in three different stages. First is input of transactions and events, which is identification of transactions and events and their measurement in money. The second stage is process, which is recording, classification, conclusion, analysis and interpretation of financial transactions. And the last stage, which is report, which includes presentation of report to the users of financial information. The characteristics of accounting explain the nature of accounting. The reassembling of all these features creates a clear picture of the accounting concept. Any product or service or concept is used for specific purposes. These purposes explain why accounting is used. The very first objective of accounting is permanent records. The preparation of accounts is in written form and in the present time, stored as soft copies. Both forms of accounts have the quality of permanency. This permanency is useful for future evidence requirements such as resolving disputes between two parties. From the viewpoint of taxation and other legal requirements, maintaining accounts for a certain period is mandatory. This maintenance is possible only when accounts are in manual written form or in the soft copy form. This permanency is also useful for the account preparer to check the financial growth of the business unit. The second objective of accounting is to recognize the transaction impact. There are rules for the preparation of accounts. In addition, accounting follows certain principles, traditions and conventions. Incorrect recording or omission of transactions would create misleading results because each transaction affects the overall profitability or economic condition of the business. Thus, accounting helps to provide a clear picture of accounts by including all business transactions. The third is identify dominant factors. Accounting is influenced by economic and political factors. Any change in these factors might create a positive or negative impact on the overall results of the company. The information on factors affecting profit or loss as well as the economic condition of the business can be obtained by preparing accounts. This objective plays a vital role in the preparation of accounts. These are external and non-controllable factors. The fourth objective of accounting is to determine the tax liability. The government has only one source of finance and that is tax. There are two types of taxes. First is direct tax and the second one is indirect tax. Indirect tax is paid on any purchase of products or services in the form of GST, while direct tax is paid on income in the form of income tax. The determination of both types of taxes is precisely based on accurate accounts. The preparation of accurate accounts helps to determine the accurate tax liability and consequently avoid under or overpayment of taxes. The fifth objective is to see the size of payables, that is liabilities. In business, credit transactions are made in place of cash transactions, giving rise to receivables and payables. Receivables are assets and payables are liabilities. For example, purchasing raw material on credit for rupees 50,000 creates a payable, which is an amount to be paid in the future as per the agreed agreement. Until this payment is made, it is treated as a liability. The size of liabilities impact the economic conditions as well. Higher liabilities indicate lower financial solvency, while lower liabilities indicate higher solvency. At the end of the year, the quantum of liability can be ascertained from accounts, and further it indicates impact on financial status of the company. The sixth objective of accounting is to see the size of receivables. Similar to credit purchases, goods are sold on credit to customers, creating receivables to be collected in the future. Until the amount is received, it is shown as receivables in the books. Receivables have a positive relation with economic condition. Higher receivables indicate higher solvency and lower receivables indicate lower solvency. This information can be obtained from the accounts. The seventh objective of accounting is to measure the profitability of business. The main objective of any business enterprise is to earn profit, and a significant objective of accounting is to measure earned profit or incurred losses for a respective period. The positive difference between income and expenses is profit, while the negative difference is loss. For example, if a business unit has an income of rupees 15 lakh and expenses of rupees 11 lakh 50,000, the difference of rupees 3 lakh 50,000 is profit. This difference is obtained by preparing the profit and loss account, the measurement of profitability made available by accounting. The eighth objective of accounting is to know the economic status of the business. There are three components to measure the economic status of a business: capital plus liability and assets. For example, if assets of the company are rupees 25 lakh and liabilities are rupees 18 lakh, then difference of rupees 7 lakh represents the owner's capital. If liabilities are rupees 15 lakh, then difference of rupees 10 lakh represents the owner's capital. Comparing these two cases, the second case has a better economic status. At the end of the year, the size of capital, liabilities and assets can be seen from the accounts. When assets and receivables exceed liabilities, it indicates a good economic condition known as solvency. The ninth objective of accounting is to detect and avoid errors and frauds. In accounting, the going concern and periodicity concepts are applied. The going concern concept assumes that the life of business is indefinite, while the periodicity concept prepares accounts at 12 months intervals. The auditing system in accounting helps detect mistakes and financial crimes during account preparation. Accounting helps prevent such undesirable events by maintaining indirect control to avoid errors and frauds. The 10th objective of accounting is assisting management in managerial decisions. As discussed, from accounts, profitability can be measured, financial status can be seen, and mistakes or financial crimes can be detected. Based on these historical results, management can form future strategies. Understanding the benefits that can be derived from accounting is essential. Accounting serves various advantages to accountants, management and other users. Let us see the advantages of accounting. Accounting is a social science. This science is used in the entire world. Its utility discloses its advantages. The very first advantage of accounting is quick accessibility of accounting data. Accounting information is prepared by the owner of any business. The use of accounting information is not confined to owners only. Different stakeholders are interested in specific information from accounts. In accounting, accounts are prepared on a daily and regular basis, which is a basic feature of accounting. Consequently, accounting data is always available and can be accessed at any time. In the present time, accounting is also completely computerized, making it very easy to acquire information quickly. If this information is readily available, it can be used by the owner as and when it is needed. For example, an owner wants to obtain a loan from a bank. He can produce prepared accounting information to show his economic status and obtain the loan. Other stakeholders can use the information as per their needs. In corporate settings, quarterly and half-yearly accounts are also provided to users. Second advantage of accounting is to measure the earning ability, that is profitability. The measurement of earning ability explains the excess of income over expenses or the excess of expenses over income, as the case may be. During a specific accounting period, how much profit is earned or how much loss is incurred by the business is provided by accounting. This information is ascertained from the profit and loss account. The concept of profitability explains the efficiency of a business in earning profit to make the business financially sound. When a higher amount of profit is earned and reinvested in the business, it enhances the economic soundness of the business. Third advantage of accounting is to know the financial status. There are four important elements of accounting: income, expense, assets and liabilities. Income and expenses are used to know the profitability of the business, while assets and liabilities are used to measure the financial status of the respective business. Thus, at the end of the period, the size of the business's liabilities can be ascertained. If the size of liabilities is large, it indicates a weak economic condition, and if the size of liabilities is small, it indicates a good economic condition. These economic status can be ascertained through the balance sheet. Fourth advantage of accounting is tax planning. Considering the nature of income tax payment is mandatory for all eligible taxpayers. Business enterprises are highly influenced by tax payments as they are liable to pay direct and indirect taxes to the government. Tax payment is determined based on different parameters or provisions in the respective finance bill. These accurate and precise amount of tax payment is available from prepared accounts. The time period or date of tax payment is predetermined as per the norms, and for tax payment true and fair data is provided by the accounting system only, that is by the accounts. From this information, tax payable during the period can be planned. The fifth advantage of accounting is valuation of business. According to the going concern concept, the life of a business is assumed to be indefinite. However, the life of the owner is not indefinite, so he may require to sell his business. In this situation, the valuation of business becomes unavoidable. Under these circumstances, the earning ability of the firm and the economic condition of the business enterprise is measured, and based on these information, the selling price of the business is determined. This information is provided by accounting. Therefore, accounting assists in business valuation. The sixth advantage is decision making. Different forms of business like sole proprietorship, partnership firms, companies prepare their own accounts. Specifically, the accounts of a company are used by several stakeholders like creditors because they provide goods on credit. Second is shareholders because they have provided capital to the company. Third is potential investors because they want to make investment in the company. Banks and financial institutions because they want to disburse loan to the company, etc. Accounting plays a vital role in decision making for different stakeholders for different purposes. The seventh advantage of accounting is as evidence. The formation of account is based on accounting rules and principles. Thus, accounting prepared in this manner are considered reliable. Further, accounts are in written form and these qualities of reliability and written form enhances the authenticity of the accounts. In case of any dispute regarding account settlement between debtors and creditors, accounts provide a crucial base for the correctness of accounts. Eighth advantage of accounting is comparison with past operations. The rules and principles of accounts do not change. Therefore, accounts of two periods can be compared. Due to this feature of accounting, present performance in terms of profitability or economic condition can be compared with the past performance and future strategies can be developed by the company. Additionally, accounts can be compared with the accounts of competitors as well. Ninth advantage of accounting is moral control. Accounting is a social science and thus accounts are prepared based on present rules, principles and standards. No subjectivity is allowed during the preparation of accounts. Accounts are in written form and these rules, principles and standards keep accounts uniform and error free. Thus, the chances of fraud by employees are minimized. Accounting helps maintain moral control over employees. The next advantage and the last advantage of accounting is corrective measures. The uniform system of preparation of accounts brings the quality of comparison. Through comparison, positive and negative results can be observed. Any negative result or deviation from planning can be corrected for the future. While financial accounting provides historical results, it can be used for future corrections. To avoid the recurrence of such mistakes, corrective measures and necessary care are generally taken. Generally, no concept is 100% free from limitations. The applicability of accounting rules, principles and standards may create certain hurdles or limitations during the preparation of accounts. Let us examine these limitations and their appropriateness. Limitations of accounting. The very first limitation of accounting is non-financial transactions. Qualitative factors play a vital role in enhancing the earning ability of a company. Qualities like honesty, loyalty, commitment and skill of employees and management significantly contribute to business development. However, these aspects are not considered in accounting. For example, Mr. X is a highly skilled employee whose skills helps the company to achieve all the targets. If he suddenly leaves the company to join another, this situation is not given any accounting treatment, and due to the rules of accounting, the migration of Mr. X represents a significant future loss to the company, but it is not recorded in the books. The second limitation of accounting is stable value of money. Accounting is influenced by economic and international changes. One of the crucial problems in the economy is inflation, which reduces the purchasing power of currency. Accounting assumes that the value of money is stable. For example, an asset was purchased before 5 years for rupees 50,000. If replacement is required to be done, then in this case more than rupees 50,000 has to be paid to acquire same type of asset due to the inflation. However, this replacement value is not disclosed in the accounts. Accounting assumes that the value of money remains stable, which is practically impossible. This assumption can be treated as a limitation of accounting. Next limitation of accounting is historical transactions, events. The synonym of financial accounting is historical accounting. In accounting, historical transactions or events are recorded, analyzed and interpreted. History cannot be corrected. This is the biggest limitation of accounting. However, based on historical information, necessary actions and remedies can be taken for future transactions. Fourth is partial avoidance of market value. The profit and loss account is prepared on the basis of present market value like purchase of raw materials, sales of products, payments of wages, etc. However, the disclosure of assets and liabilities in the balance sheet appear at historical values only. This lack of uniformity in the accounting system is a limitation. The next limitation is use of estimates. In accounting, items like bad debt reserve and market value are determined based on estimates only. If these estimates are incorrect, they can lead to wrong results in the annual accounts and adversely affect the future plans. The next limitation is dual standards. There are two important components of accounts, profit and loss account and the balance sheet. Profit and loss account, which is also known as the income statement, is prepared based on current prices, while items in the balance sheet are disclosed at historical prices. This kind of disparity prevails, leading to dual standards in accounting. Despite these limitations, accounting plays a very practical and important role for all the business and non-business organizations. It is useful to both external and internal users in different ways. Let us recollect the discussion of this module. First of all, we have studied about the relevance of accounting for BBA degree. Accounting as a subject or education is not confined to specific users. It is needed everywhere, whether it is a house or business, small business or big business, business unit or non-business unit, etc. The second is, it is essential to know the inception and evolution of accounting, which we have studied in introduction. Then meaning and definitions of accounting makes readers and learners of accounting very clear about its existence. Thus, focus is made on meaning and definitions of accounting as well. Characteristics of accounting explains formation and working process of accounting. This aspect is also covered in our discussion. Then why accounting is used and what are the purposes of use of accounting are studied through objectives of accounting. And then any product or service or system has its own benefits. To whom and how it is advantageous is understood through the advantages of accounting. And then lastly, no system is 100% error or limitation free. Accounting also has certain limitations, and these limitations reduces the utility of accounting to that extent. For better understanding of accounting, its limitations are also discussed in this module. In second part of fundamentals of accountancy, we will discuss about methods of keeping books of accounts, difference between bookkeeping and accountancy, users of accounts, fundamental accounting equation. Keeps on refreshing part 1 of fundamentals of accountancy and wait for part 2. I hope you liked this session. Thank you.